The silver price just reset. The next move will shock everyone. Have you ever watched a tidal wave recede just before it crashes ashore with its full force? In the financial markets, we just witnessed the equivalent. Gold experienced its largest nominal one-day drop in history, and silver plunged by over $4 at one point. To the uninitiated, this looked like a catastrophic end to the precious metals rally. But what if this violent pullback wasn't the end? What if it was the opposite? What if this was the final deceptive exhale of a market gathering its breath before an irreversible generational repricing? This isn't just volatility, it's a structural shift disguised as a price correction, and understanding this difference is the key to navigating what comes next. The prevailing problem in the market for gold and silver is one of perception versus reality. For decades, these metals have been traded predominantly through paper derivatives, futures contracts, ETFs, and other financial instruments that provide price exposure without the inconvenience of physical ownership. This paper market is orders of magnitude larger than the actual physical, deliverable supply of metal. The problem is that this system has created a fragile illusion of infinite supply. The recent price action has exposed the deep and growing cracks in this illusion, presenting both a tremendous risk for those who misunderstand it and an unprecedented opportunity for those who see it for what it truly is. The core issue can be best described as violent growing pains. For years, the precious metals space was a niche market, primarily occupied by dedicated long-term accumulators, often called stackers, and the methodical large-scale purchasing of central banks. It was a relatively small, stable, and predictable ecosystem. However, the paradigm has shifted dramatically. The market has been flooded by a deluge of new participants: hedge funds, algorithmic traders, day traders, and a massive wave of retail investors seeking a safe harbor from the relentless devaluation of their fiat currencies. This isn't just more customers walking into a candy store. This is the financial equivalent of the iconic "I Love Lucy" episode in The Chocolate Factory, where the conveyor belt has been sped up to an impossible velocity and chaos has ensued. This chaos is the catalyst for disruption. The fundamental driver is not a sudden, irrational speculative fever, but a rational response to decades of reckless government policy. The true catalyst is the terminal stage of a global fiat currency experiment that began in 1971. Governments worldwide, led by the United States, have engaged in an unprecedented campaign of currency creation and debt accumulation. The national debt has spiraled to levels once considered unthinkable, and central bank balance sheets have ballooned into the trillions. This isn't abstract economics, it's the systematic destruction of savings and purchasing power. The flood of interest in gold and silver is a direct consequence of this policy-driven destabilization of our economies, international trade, and the geopolitical landscape. From an Austrian economic perspective, this is the predictable outcome when a society abandons sound money. In a true free market, a commodity like gold naturally emerges as money due to its unique physical properties. It is durable, divisible, portable, rare, and has a stable stock-to-flow ratio. For centuries, when gold was money, it provided a remarkably stable measure of purchasing power. The volatility we see today is not inherent to the metal itself. Rather, it is a reflection of the frantic and failing policies of governments and their central banks. Gold and silver are not the volatile assets. They are the stable anchors in a sea of volatile, depreciating fiat currencies. The rising dollar price is merely the yardstick shrinking. This understanding reframes the entire narrative. The recent price pullback is not a sign of a market top, but a symptom of a system under extreme stress. Every component of the physical supply chain is flashing red. Mints are unable to keep up with demand and are cutting back on the variety of products they offer. Refiners are facing significant backlogs. Wholesalers and retailers are consistently running out of inventory, with delivery times stretching out for weeks or even months. For any other business, being sold out of product is a sign of incredible success and overwhelming demand. Why then would we interpret this exact same signal in the precious metals market as a bearish omen? It is, in fact, the opposite, a clear sign of a profound and durable shift in demand. The tipping point is visible in the market's internal mechanics. specifically in a rare and powerful signal known as backwardation. In a normal healthy commodities market, the futures price, the price for delivery at a later date, is higher than the current spot price. This makes logical sense, as it accounts for the costs of storing, insuring, and financing the physical commodity over time. This condition is called contango. Backwardation is the inversion of this natural state, where the spot price for immediate delivery becomes higher than the futures price. It is an unequivocal screaming signal from the market that there is an intense, urgent, and unmet demand for the physical product right now. This isn't a minor technical anomaly. It is the market's plumbing groaning under immense pressure. It tells you that large players are willing to pay a premium to get their hands on actual metal today, rather than trust a paper promise for delivery tomorrow. We have witnessed this phenomenon in the silver market with an intensity not seen in decades. This signifies a breakdown of trust in the paper derivatives market and a flight to the safety of the physical asset. It is the beginning of the paper tail losing control of the physical dog. When this occurs, it signals that the market is beginning to recognize the immense counterparty risk embedded in the fractional reserve paper games that have suppressed prices for so long. The impact of this shift is a complete re-education of the market participants. Those who came looking for a quick speculative gain based on chart patterns are being shaken out by the volatility. However, those who understand the fundamental drivers are using this as a generational buying opportunity. The fear and confusion sown by a sharp price drop create the perfect cover for smart money and long-term accumulators to acquire more physical metal at a temporary discount. We are seeing a massive transfer of metal from weak speculative hands into strong, long-term hands that view precious metals not as a trade, but as a core holding for wealth preservation. Inevitably, this volatility brings up painful memories of the 2011 market peak, especially in silver, where the price touched nearly $50 per ounce before collapsing precipitously. Many are asking, why is this time different? To answer that, we must conduct a clinical comparison of the macroeconomic environments. In 2011, the silver spike was driven by fears surrounding the U.S. debt ceiling crisis and the early phases of quantitative easing following the 2008 financial crisis. It was a powerful rally, but it was ultimately broken by a coordinated series of margin hikes on the commodity exchanges, which made it prohibitively expensive to hold leveraged long positions, forcing a cascade of selling. While the catalyst in 2011 was significant, the scale of the underlying problems today dwarfs that of the previous era. In 2011, the U.S. national debt was around $14 trillion, which seemed astronomical at the time. Today, we have sailed past $38 trillion, with no end in sight. The Federal Reserve's balance sheet in 2011 was under $3 trillion. It has since expanded to more than double that figure. The level of global debt, the scale of currency creation, and the fragility of the geopolitical landscape are all profoundly more severe now than they were in 2011. The fundamental pressures that drove that initial rally have not been resolved. They have been amplified exponentially. Furthermore, the nature of the demand has changed. The 2011 rally was heavily influenced by leveraged speculation in the paper markets. Today's market is characterized by the unmistakable signs of a physical supply squeeze. The backwardation, the retail shortages, the logistical challenges of flying bullion across the Atlantic to meet delivery demands. These were not the dominant features of the 2011 peak. This is a far more foundational and powerful movement, driven by a global awakening to the endgame of the fiat currency system. This is not just a hedge against a temporary crisis. It's a permanent shift in asset allocation away from counterparty risk and toward tangible wealth. The immediate aftermath of this pullback will likely be a period of consolidation. The market needs to digest the rapid price movements and allow the physical infrastructure to catch up with the new reality of higher demand. However, this should not be mistaken for a new bear market. It is the platform from which the next, more powerful and potentially historic leg of this bull market will launch. The underlying forces of currency debasement and sovereign debt crises are not just continuing, they are accelerating. Every government action to stimulate the economy or solve A debt problem through more printing and more borrowing is simply more fuel on the precious metals fire. This brings us to the core lesson, the crucial distinction between being a trader and being an accumulator or a stacker. The trader is consumed by the daily, hourly, and even minute-by-minute fluctuations in the dollar price. They are on a precarious emotional roller coaster, susceptible to being shaken out by the very volatility that creates opportunity. The stacker, by contrast, operates from a completely different philosophical framework. They are not concerned with the short-term nominal price. They are focused on the long-term accumulation of physical weight, of tangible ounces of gold and silver. The stacker's philosophy is one of profound patience and discipline. They understand that their goal is to convert depreciating paper currency into a timeless store of value. From this perspective, a price pullback is not a cause for alarm, but a reason for gratitude. It is a gift, an opportunity to exchange a smaller amount of their labor, represented by their fiat savings, for a larger amount of real, enduring money. They hope for lower prices, because it allows them to increase their holdings more efficiently. They buy consistently, in small, steady increments, dollar cost averaging their way into a position of long-term financial security. This approach transforms precious metals from a source of anxiety into a source of peace of mind. It is a market-based insurance policy against the inevitable consequences of government fiscal and monetary malpractice. Like a fire extinguisher in your home, you acquire it hoping you never have to face the emergency for which it is designed. But knowing it is there provides a sense of security that is impossible to quantify. As your physical stack grows, your concern over the daily price fluctuations diminishes, replaced by a quiet confidence in the enduring value of what you hold in your own possession. In the current environment of strained supply chains, this philosophy offers tactical advantages. When premiums on pure, 1-ounce silver eagles or gold maple leafs are high due to bottlenecks at the mints, the savvy accumulator can pivot. This might be an ideal time to look at so-called junk silver, or pre-1965 U.S. constitutional coinage. These coins contain 90% silver and can often be acquired at a much lower premium over the spot price, especially during periods of market stress when large investors are focused on COMEX bars. Diversifying the type of physical metal you hold is just as important as the decision to hold it in the first place. The beauty of this strategy is its independence. It does not rely on a brokerage firm, a fund manager, or an insurance company. It removes your savings from the complex and highly leveraged financial system with its layers of counterparty risk and places it directly under your control. This is the act of getting on your own personal gold standard, even as the world economy flounders on a sea of paper. It is a declaration of financial sovereignty, a decision to opt out of a system that is mathematically destined to devalue the savings of its participants. So what is the ultimate takeaway from this historic pullback? It is a confirmation, not a refutation, of the precious metals thesis. The growing pains we are witnessing are the telltale signs of a market in transition, evolving from a small niche interest into a major global asset class. The chaos in the supply chain, the frantic movements in price, and the disconnect between the paper and physical markets are all symptoms of a powerful new reality dawning. The world is rediscovering the true nature of money. The future we are heading towards is one where tangible assets reassert their historical role. The decades-long experiment with unbacked fiat currency is reaching its logical and inevitable conclusion. The massive overhang of debt can never be repaid in real terms. It can only be inflated away, defaulted upon, or restructured. In every one of those scenarios, the purchasing power of tangible assets like gold and silver will not just be preserved, it will be magnified. The current volatility is the price of admission to what is shaping up to be one of the largest wealth transfers in modern history. This is not an investment recommendation, but an economic analysis. The path forward will not be a straight line. There will be more volatility, more attempts by entrenched interests to manage and suppress prices, and more periods of doubt and confusion. But the underlying, tectonic forces are now too powerful to be contained. The global demand for a reliable store of value, independent of government control and counterparty risk, is only in its early innings. The recent pullback was not the storm itself, but merely the sky turning dark. Therefore, the prudent course of action is to see the big picture. Zoom out from the daily price charts and look at the multi-decade trend of rising debt and currency debasement. Recognize that what is happening is not an anomaly, but a reversion to the mean. For thousands of years, gold and silver have been the ultimate form of money. The last 50 years of a floating fiat standard are the historical aberration. We are now witnessing the painful but necessary process of the world returning to a state of financial sanity, where value is anchored in something real and finite. The chaos in the market is a direct reflection of the chaos in our economic and political systems. As governments become more desperate, their interventions will become more extreme. Interest rate manipulations, capital controls, and further currency devaluation are not off the table. They are the likely next steps. In such an environment, holding a portion of one's wealth outside of that system is not just a strategic advantage. It is a fundamental necessity for preserving one's financial well-being and freedom for the long term. The influx of new participants, while causing these growing pains, is also building a much broader and more resilient foundation for the market. Each new person who decides to buy a single ounce of silver or a gram of gold is another vote of no confidence in the existing financial architecture. This is a grassroots movement, a quiet revolution of savers seeking to protect themselves. This broad base of ownership is far more stable than the leveraged speculative interest that characterized previous market peaks, providing a much stronger floor under the price. The supply and demand fundamentals for both metals, even beyond their monetary characteristics, remain incredibly strong. Silver is essential for a vast array of industrial applications, from solar panels and electric vehicles to electronics and medical devices. This industrial demand creates a constant consumption that paper markets cannot ignore indefinitely. Gold continues to be a cornerstone of central bank reserves and a vital component in high-end electronics and dentistry. These diverse sources of demand provide a flexible and robust buffer for the market. Consider the perspective of the businesses involved in this sector. They are scrambling like mad to increase their capacity and secure more product. They are investing heavily to expand their operations to meet this new wave of demand. These are not the actions of businesses in a dying industry or a topping market. These are the actions of businesses at the very beginning of a long-term secular bull market. They see the writing on the wall, and they are positioning themselves for a future where their products are in even higher demand. The psychological element cannot be overstated. For decades, the mainstream financial media has either ignored or ridiculed precious metals. They have been labeled as relics, pet rocks with no place in a modern portfolio. This narrative is now collapsing under the weight of economic reality. As more people experience the pain of inflation and asset bubbles, they will inevitably seek out alternatives. The current pullback serves as an entry point for those who were waiting on the sidelines, creating the next wave of buyers. Let us revisit the Lucy and Ethel analogy. While the scene in the chocolate factory is one of pure chaos, it's driven by one thing: an attempt to meet overwhelming demand for the product. The solution wasn't to shut down the factory, it was to eventually adapt to the new, higher volume. That is precisely what is happening in the precious metals market today. The system is being forced to adapt, and in the end, the price is the mechanism through which this adaptation occurs. The only way to balance this intense physical demand with the finite physical supply is through a significantly higher nominal price. Therefore, the question, "What's next?" can be answered with a degree of confidence, not by predicting a specific price on a specific date, but by understanding the unchangeable trajectory of the underlying forces. What comes next is a continued battle between the paper and physical markets, a battle the physical market is destined to win. What comes next is a growing global realization that wealth is not the paper that represents it, but the tangible assets that endure. The historic pullback is a pause, a test of conviction. It is a moment of clarity for those who have done their homework, and a moment of panic for those who have not. It has washed away the froth and left the solid foundation exposed. For those with a long-term perspective, this is not the time for fear. It is a time for disciplined, steady action. The conveyor belt has been turned up, and the opportunity of a generation is rolling past. The question is whether you will be overwhelmed by the chaos or calmly continue to stack the real, enduring value that is being revealed. Ultimately, the future price of gold and silver in dollar terms is less a reflection on the metals and more a report card on the stewardship of our currency. Given the current trajectory of government spending and debt, that report card is destined to show a failing grade. The growing pains in the precious metals market are the early tremors of a financial earthquake. This recent pullback was not the main event. It was the final, quiet moment before the ground truly begins to shake.